50% to net present value or to book value. And what that means is that we're going to have to see concrete signs of improvement. It's really tough. She has a change of leadership in the wealth management area, and that gets to Shanali's point about competing with UBS and Credit Suisse.
Ken, given the year ahead, is international a positive or a negative in 23?
John, I think it's actually moving to a surprise of the positive. The reopening of China, potentially Europe not getting crushed from natural gas prices. All of a sudden, and for you, large U.S. banks, the other three large ones, it's about 15–20% of their total revenue. But for investment banking, that could be interesting as we go into 2023, a little bit further down the road for Goldman and Morgan Stanley. For Citi, though, this is the heart of their business, is really international and having this streamlined network for corporate treasuries. But it's not there yet. They have to invest in their technology platform.
Stocks down this morning by 2.4%. We can go through some of the banks in the pre-market just briefly. Got Citi softer, Bank of America down by 2.5%. Got Wells Fargo down by 4%, JP Morgan down by about 2.8% or so. So negative across the board here. Looking at the financials, the broader equity market down 1%. Just want to finish on this, Ken, just on the international outlook. This from Neil Dutter of Renmac. Tom and I were discussing it just moments ago. Europe is warming up, likely avoiding a technical recession. China is reopening. The Fed is stepping down from an aggressive rate hike pace, and fiscal policy is no longer a drag. The Fed expects real GDP in 23 to slow down to 0.5% Q4 on Q4. He says this, Ken, good luck with that one. Ken, do you agree with that?
I think if you have an environment of not too hot and not too cold, it's a great environment for financial sector, particularly banks, where the expectations are not as high as perhaps other areas that have benefited with a strong bull case scenario. Banks actually are in a pretty good position for performance for 2023 as we see it. And we just want to see it one bank at a time have a more constructive view as we get through the earnings calls.
Hey, Ken, thanks for being with us this morning. For the last couple of hours, we really appreciate it. Ken Leon there of CFRA, breaking down the banks. JP Morgan, Citi, Bank of America, Wells Fargo, all behind us. Looking forward here, Shanali. Next week, Morgan Stanley, Goldman Sachs Tuesday, right? Both of those banks?
Same time, same place. 6:30, both of them at the same time. It will be, their competitive dynamic, guys, is just out of control. Yeah. And that will be something for the ages.
You said the stereotype that Citigroup is international, and you alluded, I don't, no disparagement, Shanali, but this is a zeitgeist out there that Citigroup leads internationally and JP Morgan and the others don't. I'm not sure I agree with that, in that I look at the total international revenue of JP Morgan, and there's a bunch of statistics on this that nobody cares about. Can I collegially say it's close to what Citigroup's doing internationally?
I think that if you look at JP Morgan, they're the biggest fixed income trading shop in the world, right? So investment banking trading, yes. But it's Asia, it's the Asian consumer here that's weak in Citi's numbers, and you'll see that play out at other places.
I think what I've said here, John, if I walk into a Citigroup branch, I'm not going to get a toaster. I'm not going to get a complimentary toaster.
I'd like some real interest on some deposits, Tom. I hope that changes later this year. Not happening, Shanali.
Like Bitcoin.
Not happening.
Bitcoin.
Tom mentioned this, the Citigroup CEO, Jane Fraser, in conversation with David Weston at Bloomberg's The Year Ahead lunch in Davos. That'll be cool. That's happening on Tuesday. That'll be shown in full on the Bloomberg terminal from 6 a.m. Eastern Time. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. President Biden's handling of classified documents erupted into a political crisis with potential legal repercussions. A special counsel has been named to investigate. Meanwhile, the White House has confirmed that a second set of documents was found in a garage storage area in the president's home in Delaware. Japan's Prime Minister Fumio Kishida will seek public support for his new security strategy today from President Biden. The two leaders will meet at the White House. Several weeks ago, Japan announced a radical upgrade of its security policy. It includes a 60% spending increase and plans to acquire missiles capable of striking China. 3 months ago, Goldman Sachs created a new division to house what's left of its foray on Main Street. And now it's giving shareholders a clearer look at the financials. That collection of businesses, including Goldman's Apple Card, is now a segment called Platform Solutions. Now, it racked up more than $1.2 billion in losses in the first 9 months of 2022. Tesla is slashing prices in the U.S. and major European markets after several quarters of disappointing deliveries. The electric car maker lowered the cost of its cheapest Model Y by 20%. And buyers can save as much as $21,000 on Tesla's most expensive vehicles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic. We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The last 3 months' inflation prints have been a step in the right direction. But I'd caution that while for all 3 months, while the average dropped, the median stayed high. And that's because the average inflation that you see posted in the headline number was distorted by declining prices for goods like used cars that escalated unsustainably during the pandemic.
That was Thomas Barkin, the Richmond Fed president, weighing in on the Fed's next move as several policymakers on the FOMC start to shift maybe towards a 25 basis point hike. We'll pick up on that in just a moment. The broader equity market softer this morning. Good morning to you. We're down 0.9% on the S&P 500. Into the bond market, yields are a little bit higher by 4 basis points on a 10-year, 348.15. If we can bring up the financials just briefly, can I take a look at the banks going into the pre-market, going through this morning and going into the opening bell? Equities look like this, Tom, individually. JP Morgan down by about 2.8%. Wells down by almost 4% now. Citi just out 17 minutes ago, negative 2.6%.
It's going to be interesting to see. We got to summarize this right now. It's too important before we get to our good guest here on the path forward on value equities. John, a guy yesterday acclaimed on Wall Street who advises hedge funds, I can't use his name on air, sent me a blistering note breaking out the disinflationary 6-month trend that we saw in yesterday's number. David Rosenberg, legendary, moments ago, he makes no bones about it. The Fed is doing a massive overreach. And he goes on to say they are in clear deflation mode. Subsets of inflation, John, aren't disinflating. they're moving towards deflation. This is complex into the weekend.
Mike Gapin of Bank of America published yesterday. I'm not sure if you had the opportunity to read the note, but I can show you a quote from it just briefly. He said, the details of the report were constructive. In our view, we see increased risk of a 25 basis point hike in February, but I think this is the line that you'll be looking at, Tom. Over the last 3 months, core CPI has grown at an annualized rate of 3.1% month over month, a significant deceleration from earlier this year. And I think that's what people are trying to look at, Tom, just that deceleration,
right,
those disinflationary trends that are starting to emerge, and trying to figure out how entrenched they are.
And the calculus here is we look at level of inflation, particularly in the media. Oh, you know, the president, OMG, 7% media inflation. And as you say, John, correctly, deceleration, the rates of change and the rate of change now are moving sprightly, as Mr. Rosenberg talks about.
How committed are you to the idea that that continues, particularly on the good side, with China reopening? I think that's the difficult calculation they've got to make. They're also very concerned, I think, conditioned by history, Tom, back to the 1970s. You can almost feel the weight of that around their shoulders as they make these decisions. They do not want to make a pause, Tom, or for that matter, shift away from 75.50 to 25 if they believe that later this year they get it wrong and have to start making a move again. That would be
a
major problem.
We're going to move on here in this important hour and really through the morning, get you set for the weekend as well. I do want to point out dollar yen, 128.55. Strong yen off stunning news out of Japan. We'll have that through the morning on radio and television. Joining us now on Value, he's been lonely for a decade. Kevin Holt joins us out of Iowa, out of Chicago as well. Kevin, Value's been a lonely outpost for a decade. Why is now the time for value versus growthiness?
Yeah, so I think a lot of things have come together, Tom. I mean, really, you think about it, since the global financial crisis, rates have been down precipitously until 2020. Then we had a lot of fiscal stimulus put into the system, and now rates are up. The question is, as you guys were discussing earlier, how long will they be up? Will they stay up? But it creates a more level playing field. When money's free, growth was in favor. But you have a lot of trends in technology now structurally that are also kind of maturing to a point where it's becoming tougher for those businesses to kind of, grow through cycles.
Well, is there such a thing as large cap value? I get the idea of beleaguered small caps and mid caps, et cetera, but identify large cap value by sector or individual name.
Yeah, so I think we're looking at value mainly outside of financials on free cash flow yield, and then within the financials, we're trying to look at normalized earnings. So if you're looking at normalized credit cycles and then kind of normalized net interest income, and we don't like to make expectations on rates going too far one way or the other. So that's really what we're looking at, historical valuations, and trying to discern, mostly within the market, where's free cash going, which is revenue and then margins of these businesses. And again, I'm excited because it's a very difficult environment, has been for the last 3 years. And that we seem to do very well historically in those type of environments when, digging in and trying to figure out what normalized is something that a lot of people struggle with.
Well, forgive me for getting short term, but go with me if you can, Kevin. Can we just pick up a sector and take a look at the airlines? Sure. The airlines year to date, and I'm talking about 8 trading days. Yeah. Some of those names are up 20, 30%. Kevin, what's going on with those names?
Yeah, it's my expectation, and this kind of leads into some of the stuff that I'm concerned about, but I think the market is kind of in a very lofty state at this point in time. You're seeing a lot of irrational trading. To me, that's a sign of a market top. I'm very concerned when you see stocks up irrationally 20, 30% in a short period of time. I think you're seeing a lot of rotation right now, but I think we're in for a very rough earnings season across the board. And I don't think those, I think it's going to be tough for most stocks, here in the next 3 to 6 months.
Kevin, just on that rough earnings season, you understand the arc of earnings season. It starts with the financials. You get some tech, retail at the back end. Where is it that you think we begin to draw some real conclusions with conviction as to the idea that this is rough and it's going to get rougher?
Yeah, I mean, if you start to look, I think in the banks today, the earnings are sloppy. We've seen a peak in net interest income. So I think that's going to fear investors. Everyone is guiding down or missing out on net interest income for the most part. Expenses actually came in a little bit better than I would have thought today so far. But then, your revenue trends within investment banking and trading are very weak. So I think you're starting to see, as you see, that's a sign of what the consumer is going to do. It's a sign of what corporations are going to do. And I think we're seeing revenue weakness. And I think expenses for a lot of areas, today I was actually surprised on expenses so far. I think expenses and wage inflation are going to be a problem for a lot of companies as we move forward.
Kevin Holt of Invesco. Kevin, enjoyed that. Thank you, sir. That's the takeaway from the team over at Invesco on the value side, Tom. Things are going to get tough. Expenses are going to be in focus.
Short answer here is there's value and growth. That's what we were taught. And there was a period where maybe value had a couple years there, but basically it's maybe 1 out of 2 out of 10 years value outperforms. Someone like Lori Calvasina, I mean, she's aged, waiting for value to come on here. And the answer is, okay, maybe this is value's year, spurred by weak dollars, spurred by international, and maybe what that does to mid and small caps as well. But I really wonder about value large cap. The question I wanted to ask him, is Apple a value stock? It's down X%. I don't know. Tim Cook's taking a pay cut.
Yeah, I saw that.
Yeah.
Yeah, if my pay was that, I wouldn't mind that pay cut. Did you see what it comes
He's
down
falling
to?
on a
Was it
sword there.
40-something
Maybe
million?
Mr. Diamond maybe will take a pay cut.
Yeah,
I've offered.
Got some small violins for.
I've offered.
For that, have you?
Yeah,
We're going to have a chat about that.
I said, Mike, if you want to starve vet bill, I'll take a pay cut.
You've offered.
Yeah, Mike said yes.
Well, I'm pleased you've done that. It's very kind of you.
Thank you.
Thank you for doing that for us.
No, this is silly. John, I'm sorry. This is silly where we are with these banks. Look at the size, the billions of their profitability. We can't frame it. It's so big.
Well, we've mentioned this a few times. They're conservative institutions, unsure about the future.
And regulated is one of our guests said.
You build reserves. That's what you do.
And you're doing it with Michael Barr coming in. This is not Bloomberg Radio sports guy. This is Michael Barr, first order academics, and with some real rigor. He clerked for David Souter at the Supreme Court. And the answer is Michael Barr is going to come in as a new regulator on the block. And I think some of the presentation today is with Mr. Barr in the future.
I'm done. Enjoy the long weekend.
You done? I will.
Well, I'm not done, just done with you. And then I'll see you on Tuesday.
We'll see you. Yeah.
We hanging out this weekend, watch some football?
I'm going to watch Sundays. Sunday's a derby. Or it's a derby.
So you want to watch the North London derby? Yours
yeah,
Right, come to mind.
I'm going to watch some Swiss football too.
Bob Dollar-Crossmark, Jim Karen of Morgan Stanley, Nadia Lovell of UBS, and we'll catch up with David George of Baird. All in the next hour of Bloomberg TV.
seeds, typically between the time you start and they get out in the farmer's fields is about 8 years. Now we have a pipeline of innovations. We've been funding this CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg. Bloomberg Surveillance, 8:29 Wall Street time. We welcome all of you on Bloomberg Radio, Bloomberg Television Worldwide. What happens now? People like Sonali Basak, Max Abelson, and others on our financial team lean into the conference calls. You want to pay attention to what we're doing through the morning. There may be some nuggets there, and certainly each company has a different character, a different approach, and we will see how that goes. Where we are in the banks right now, a little bit of up, a little bit of down as well. Looking out at some challenges. We're going to get briefed right now on that with, futures down a little bit off a buoyant week, to say the least. My number for the week is simple. The VIX has moved. For Global Wall Street, a huge deal, 21, 22, even 23, waiting for the measure of volatility, the S&P 500, to give way. It gave way on the inflation number from 20 down to 19.33, and that's off an 18 shock overnight. So watching the VIX carefully on, I'm not going to call it a bull market, but certainly it's been a January surprise. Not much else going on data. Yields a bit higher, 5 basis points on the 10-year yield. Oil, $84 on Brent, something to think about into the weekend to recalibrate. And on the currency market, very, very important here to see continued yen strength. For those just joining, I want to make clear the Bank of Japan yield curve control theory unravels. We don't want to get out in front of the story. Others have said they will abolish yield curve control. Some say it's under heavy discretion. In Japan, I would say the British phrase OBE. They're overcome by events. That's what's happening there now with 3% inflation and the Japanese public challenged by this new pain of inflation. Again, yen 128.43, euro 108. I think we'll move on from there. Euro Swissy, John Farrow focused on the Swiss franc right now. Euro Swissy 1.01. I'm going to call that noodling, which is maybe what we will see over the weekend. Right now, to make us smarter with some really important insight, linking economics into what we see in the financial space, Dana Peterson, of course, her acclaim at Citigroup. She's chief economist at the conference board as well. Dana, are we anywhere near a recession? Brief me into the weekend.
Sure, it's really hard to say. I mean, even though that's our forecast for the early part of this year and extending into the middle of the year, consumers still seem to be spending. The labor market still seems to be strong, especially with huge amounts of hiring in those in-person services and healthcare. But certainly when you look at housing, the housing activity is certainly weakening. We're seeing starts and sales down, and that's influencing pricing, which is actually a good thing. Hopefully it'll show up in rents, in the CPI and the PCE, but it's really tough to say at this point. We need more data.
Okay, we need more data. You sound like an economist, okay? You need more data. Critically, are you going to have the data to adjust dots or to have confidence in trends by the February 1st Fed meeting? I don't buy it. I think what we're going to say is we need data into the spring.
Well, we will have GDP before the next Fed meeting for the fourth quarter. And we're probably around 2% annualized, which is pretty strong ending the year. But a lot of that is because you had very strong momentum heading into the fourth quarter. And also consumer spending was healthy in October. And if you have a good first month in a quarter, it tends to carry through.
Dana, very important question. I mean this with immense respect for your contribution to Citigroup as well. We have executives, CEOs of banks trying to be Dana Peterson. Jane Fraser, I'm sorry, she's channeling Dana Peterson. They're trying to guess a recession. What is your advice to mere mortals like chief executive officers managing a strategic message who are trying to game economic recession? Can they succeed?
Well, I don't think it's a self-fulfilling prophecy or they're trying to create a recession. When you look at what the Fed's been doing, I mean, the Fed's raised the federal funds rate by 450 basis points. We're probably in for another few rate hikes. That all signals a significant slowing in demand and even also a recession. The thing that's different this time around from other recessions is labor shortages, and certainly have a number of industries that are still trying to recover. And so as long as you have labor shortages, businesses are less reluctant to let people go. And as long as people are working and they're seeing their incomes rise, especially at the lower end of the spectrum, then, it's really up to the consumer. Will consumers stop spending if they think they're still going to have a job?
Dana, one more question before we get a brief into the weekend with Mr. McKee. Dana Peterson, just real simple. I love your paragraph on experiential services. What in God's, did you learn this at Wesleyan? I mean, in Middletown, Connecticut years ago, were you experiential? What is an experiential service?
Well, basically anything you can go out and enjoy, like a hotel or a restaurant or
Bloomberg
a movie
surveillance. Yeah, keep it going.
or Bloomberg surveillance, certainly. But those are experiential services, and that's what people are demanding right now after being cooped up for 2.5 years. And that's really making it tough for the Fed to bring down inflation, in addition to the fact that rents are very elevated. It's the fact that people still want to go out there and enjoy things, and as long as there's demand for that, it's going to put upward pressure on prices for those services.
Dana, thank you so much. Greatly appreciate it today. Ms. Peterson is with the conference board there with important research notes. Look to the conference board for her notes. We protect the copyright of all of our different guests. Treasured right now is the copyright of Michael McKee. His Friday note is read far and wide across the Bloomberg world, and we're thrilled Michael McKee could sum into the weekend. My head is spinning. 2022, you and I know, was nuts. Remember the old Angry Beavers cartoon on Nickelodeon?
Yeah.
That's nuts. That's the way 2022 is. Am I right, Mike? It hasn't stopped?
It hasn't stopped, but we're getting a little more defined. We're falling into a channel, I would say, of we're about done with the Fed rate increases. If you listen to the Fed, if you listen to the market, they're going to start cutting rates. So that's going to be the fight going forward. And then it just becomes a matter of how long does it take the cumulative effort of the Fed's tightening to bring down inflation to a level at which the Fed will start talking about some kind of pivot.
You and I in our youth, Rick Wagoner of Generous Motors, he would try to game China GDP. And that was a responsible thing to sell units in China a million years ago, or Caterpillar or Deere or that. How do you respond to bank CEOs acting as economists trying to gauge a U.S. recession?
Well, they've got to do that in the sense that they're pretty much the closest tied of almost any sector, I guess you'd say consumer products, but to the economy, because they're going to be the ones who are responding to the Fed by raising or lowering their borrowing costs, and they're going to be the ones who see the impact from consumers who are either putting money in or taking money out. So for the bankers, it's kind of interesting. I note that Ms. Bassick has joined us here on set, and one of the things going to be really interested in listening to today is from the calls is what their forecast for consumer spending is going forward, what they see in their data, and also are there any sectors that are reporting problems, particularly with their loans, because so far the consumer's holding up, as Tom says.
Conference calls.
And as far as the conference calls goes, to the point that Mike is making, as far as cards go, credit cards, they're holding on strong. That's where a lot of these reserve releases are even coming from. But if you look at other areas like home, there's a lot of questions still on auto. JP Morgan just started their call. So, like, let's not get too excited yet.
We
don't have all
the privilege of speaking to you. You're not on the call.
Well, we have about 7 people on the call from Bloomberg alone, so we could follow it on the Top Live blog.
Nice sales point there.
Well, there are many calls going on at the same time, including Citigroup CFO speaking to journalists while JP Morgan addresses investors right now. And so your point here, how much of that consumer do they want to get as rates are higher? Even if they were to pause or decline, you still have higher rates here. And remember, I think a very important point here is there's only so much money to be made when you expect that even though JP Morgan's net interest income is going to rise, it's still going to come in below analysts' expectations this year.
Well, that's a different thing. Trading the banks and their stocks is your area, whereas I'm looking at what they're saying about the economy, because so far we haven't seen even sectoral problems outside of housing, really, and autos has been more of a supply chain problem. So are we seeing anywhere where in a traditional recession you would see some lending problems?
In the last 20 minutes, make it 40 minutes, I've had Torsten Slok Apollo, Neil Dutta Renaissance, and David Rosenberg up in Toronto with nothing better to do this morning, simply say the Fed is wrong. How wrong is the Fed, Michael McKee, right now? Help Slok, Dutta, and David Rosenberg.
Neil Dutta and I were discussing this over the IB on Bloomberg this morning, another Bloomberg tout here. My argument is that the Wall Street has this tendency to look at what the Fed forecast 3 months ago. In this case, it's just 1 month, but it's still a month ago, and compare that to what the market sees right now and say the Fed's wrong. I mean, the data we have on unemployment, the data we have on GDP, the data we have on inflation, none of that was available to the Fed on December 14th when they put out that last forecast. And also they put out 19 forecasts. And then we just pick a middle, a median, and say that's what the Fed is forecasting, and that's not correct.
One final insight here. What are all these troops saying about traditional banking? Mom and pop banking, I'm going to call it as a general statement.
I don't want to be too extreme about it, but is it dead? I mean, the question about it is, what happens to those Main Street lending businesses? There's been a ton of consolidation. Guess what? At times like these, when valuations come down, there tends to be a lot more. I heard you talking about Michael Barr over at the Fed as well. Will he allow that to happen?
There's a lot of worry about
Probably
this
not,
guy. Explain, you got 20 seconds. Why is Michael Barr at the Fed such a big deal? This has come up 3, 4, 5 times today.
Clearly, the administration.
Is he the Elizabeth Warren of Yale Law School?
Well, there's already been a tough on the banks, kind of tough on finance outlook here under the Biden administration. This is the last shot, really, before the next cycle for the industry reins to loosen up once again.
A lot of decisions have to be made by the Fed, which have not been made yet, and Mr. Barr is the decision maker.
Dip into the conference call. Maybe Jack Rubin will be on it. Sonali Basak here, covering all of our banks, and Michael McKee, the only guy who actually knows who Jack Rubin is, with us as well. Seriously, this weekend, just fascinating as we reset for January into that Federal Reserve meeting of February 1st. Futures negative 37, Dow futures negative 269. A little weight to the tape. The VIX 19.24 on radio. On television, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Alabama and Georgia, violent weather killed at least 7 people. Much of the damage took place in Alabama, where a tornado cut a 20-mile path across 2 rural communities. 6 people were killed and more than 36 homes were damaged or destroyed. The FAA is out with preliminary findings on the computer failure that grounded all departing U.S. flights on Wednesday. The agency says it was caused when a data file was damaged due to a failure to follow government procedures. Now, according to the FAA, unspecified personnel were responsible for corrupting the file. Two of China's largest state-owned airlines are giving up their listings on the New York Stock Exchange. China Eastern Airlines and China Southern Airlines are joining a raft of government-controlled firms that have announced their departures from U.S. exchanges. The companies attributed the decision to commercial factors, including the cost of maintaining U.S. listing. Delta Airlines is forecasting first quarter profit that fell short of Wall Street estimates, and that's a setback for the carrier's efforts to capitalize on a rebound in air travel demand. Delta is being hit by soaring labor costs. And takeover talks at Bed Bath & Beyond. The home goods retailer is on the hunt for a bankruptcy loan. Sources tell Bloomberg firms may also have the option to buy some or all of the retailer's assets in bankruptcy and set the low end of the bidding war so that others can offer less. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I do think that there's been a little bit more optimism than I would expect around the sort of durability of the economic recovery here, and the fact that maybe we can put this sort of energy shock and the interest rate shock behind us. I'm not so convinced. So I still do worry a little bit about global growth over the next 3 to 6 months and beyond.
Eric Nelson at Wells Fargo, decidedly a success for Wells Fargo in generating strategy here in these tumultuous times. Futures negative 38, Dow Futures negative 279. It is bank earnings day. We'll have much more on this. Shonali Basak and our team worldwide in the conference calls right now, generating a forward view for the great American banks. Of course, the international banks reporting here along the first quarter way. Euro 108. We'd also know Japanese yen with real strength now 128.38. You need to watch Japan in their Monday morning, which is our Sunday evening. That will be very interesting to see. We pause now, as we've done on a yearly basis, to talk to someone who had the courage to make a success in a disastrous industry. It's easy to be a success when you've got the wind behind you. But in the publishing, the magazine business, and the thinking business, long ago, Tyler Brûlé said, we need some wallpaper. And he came out with a magazine that I sort of looked at, and I said, yeah, whatever. Okay, great. And we did wallpaper. And that was great on newsstands for years. And then along came Monocle now, a stunning, I can't believe I'm saying this, 15 years ago. If you don't know Monocle, it's the magazine your kids are stealing. It's the magazine you can't get on airport newsstands because people have bought it. And what's amazing about it is the Vogue, Harper's Bazaar thickness of it. Pretty much every month is fall fashion. Tyler joins us now. It's thrilled to have you in New York, Tyler. You're based in Zurich right now. You continue this tradition. How did you keep the thickness of the magazine during the pandemic?
I mean, well, good morning and thanks. Great to see you, Tom. Part of it was the hustle, just being out there, crossing borders, getting in front of CEOs, having those conversations, and trying to be in studios and being face to face. I mean, that was really what it came down to, just being out in the world where possible.
I want to get to the money question. We'll do the publishing chat in a moment. I want to get to the money question for every single person in economics, finance, investment, and international relations. What is the Tyler Brûlé best practice or pixie dust on a day-to-day basis to create the enthusiasm for your product that you do?
I mean, part of it is just adventure, being exploratory, being out in the world, meeting interesting people, having those conversations. Cameras like this are great. On laptops, maybe not. Getting out of the house. I mean, that is absolutely.
Do you delegate authority? Like, did you guys in the pandemic? I can't imagine. I'm saying this. Was Monocle all Zoom?
No, parts of it were Zoom, but I have to say, journalists are key workers, so people were back. We were in the office. We were running a newsroom like you were.
In this magazine, folks, and for those of you on radio, it's a big, thick magazine with a fancy Rolex on the ad. They're rigging the register along with the rest of fashion. Dana Telsey with us yesterday knows this. And the whole idea here is it's one part aspirational architecture, aspirational fashion in city, city, city. You are the biggest promoter of #2 size cities, Helsinki, and the rest of it as well. Where's the city right now to live? Where's the up-and-coming city?
Well, of course, I'm on my way back to Zurich, so we like Zurich. I think Spain is interesting to look at right now.
You and Madonna. Madonna likes Portugal, Spain, the whole thing.
Well, exactly. I think she's back over in this city, I believe. But no, I think Spain is very interesting to look at right now. You've seen, obviously, they've got digital passports just launched. I'm not sure I'm sort of the biggest believer in that as necessarily as a currency. And a lot of interesting second-tier cities to look at in that market.
Rachel from Lafayette, Indiana emails in, ask Tyler about work from home. I'm fascinated by this. You want people together, mingling, talking. Can you do that with work from home?
No, you can't do it from work from home. I just came from Toronto. Some of the big towers, the banks that you have on this program, 18% in the office. I mean, this is incredible.
Yeah, but culturally, you invented this. I mean, this is really important. Everybody out there battling with this, whatever your angle, this is the voice. Work from home, what's wrong with it?
Well, I mean, multiple things. It's inefficient in many ways. It looks like it's cost savings, but of course, we have all kind of tax jurisdictional issues. Where are you sitting at home? Where is your company based? But the most important thing, all of these companies are talking about CSR. What are we doing for community? You go to the concourse of one of those big towers in Toronto, here in New York. I was in Washington the other day, empty. I mean, 50, 60% of stores empty. And then where's the serendipity? Where am I bumping into you, having that conversation? If we're on Zoom, everything is very scripted. We're very on message. Where's the spontaneity?
The spontaneity, well, maybe it'll be up Happy Valley in the next week here at Davos. But Tyler, if you're sitting down with a consultant cup of coffee with James Dimon, okay, right now he's on a conference call with his team, 288,000 employees, and he's screaming, we need to get away from work from home. What's your process to get Monocle away from work from home? What should Mr. Dimon do?
Well, I think he's probably got some decent workplaces, but I think you have to have a narrative, and to maybe not all of those people, to say, opportunity actually comes being face-to-face. I'm going to find something. There's going to be some nugget from a conversation, Tom, I'm going to walk away with, which I wouldn't get across the screen.
I noticed just in one company, Hermes opened in Nanjing and all that. The luxury is still doing well, and they're Pacific Rim based. Monocle on the Pacific Rim. How large will that China reopening affect?
We're not huge in the Chinese market for a variety of reasons when it comes to press freedom, many things like that. We don't rely on China for advertising per se. Sometimes you get some regional governments spending money, but it's not that important to us.
Do they assist Australia? Does their reopening assist Singapore? And does it assist the effervescence that you people represent?
Well, I mean, just look at Thailand as well, the way they're looking at, of course, vaccines, not vaccines, and of course, tests going into the country. So for all of those markets, China is incredibly important.
The publishing business, can I editorialize? What a train wreck. Did I get that right?
Yeah, many parts, but no, I wouldn't say in every corner of the world, but yeah, largely a train wreck. We're about to derail in many places.
How do you're in a meeting and you strategically have to say whatever the magazine is, what is the way that publishing can begin to improve?
Well, part of it is returning quality, and this is pre-pandemic. You saw this trend of magazines downgrading paper, going lowest common denominator in terms of production. And we said, no, you have to have an object you want to hold on to. The reader wants to be seen with it. And at the same time, of course, the advertiser wants to be in a quality environment. And so it's been our push to go the other direction. You have to turn a journal like the one you're holding now. It has to become an object which is collectible, and it's a luxury. It's a luxury item. You want to be seen and associated with it.
Carolina Abbott Galvayo and UC Twickenham killing that. I'm sorry for your photographer. Maria Tadeo emails in folks from Brussels and says, take the biscuit. 7 fancy people sitting outside a fancy patisserie. This is Monocle 101, isn't it?
Well, part of it. So it's a celebration of, in this case, a classic business. It's taking people to a city which, is sometimes not most loved. And we want to show, even in a small example like that, entrepreneurship and, of course, and leadership as well, Tom.
What's the trend in America? Is it most loved right now?
Well, America in this issue, it did rank #1 when it came to our soft power awards this year. America still has extraordinary soft power, of course, culturally, of course, sport. We look at an expansive NBA going out into the world. It's a tough call because, of course, there's many things that America is also exporting culturally that people on other sides of the Atlantic and Pacific aren't so interested in.
What do we look for from America? I mean, look at the World Cup coming here next number of years. Pharaoh knows that number, I don't. But the basic idea of America ascendant. Monocles, it's not so much that you've pushed against that, but you've said there are other geographies that matter. Fit America into Monocle 5 years from now. 5 years from now,
well, currently still our biggest market. I think it will continue to be our biggest market. Of course, we've got an election coming up. I was just in D.C. I've got to talk to you about real estate. Where should we have our bureau, Tom? I mean, should we go into the National Press Building, or where should we be?
I think that a Bloomberg-Monocle relationship would be good. What you could do to our claimed food court at Monocle would be something you could bring in the patisserie from Brussels. Folks, this is a celebration of somebody that succeeded in an industry that has failed. Monocles like that, that's a normal issue. Can't say enough about it for just almost like the zeitgeist, if you will, of cities ascendant in the world. Also some good journalism. Tyler Brulé invented and is Monocle. Don't forget Monocle Radio as well, which is better than good. I've got to summarize here a mostly historic day, and we do this with our team going to Davos here in a most odd year after the carnage of 2022. And I would say more than anything, as Mr. Schwab talks about fragmentation, the fragmentation of society. We're going to be real ascendant this year at Bloomberg Surveillance of trying to cover not so much the fancy people, but the people aspiring, as Tyler Brulé just talks about in Monocle, the people trying to reach up. We do that with a stunning inflation report yesterday, bank earnings today, and we'll dive into it all next week as well. On radio, on television, stay with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from New York City this morning. Good morning, good morning. Earnings season begins right now. Equity futures on the S&P 500 down 0.9%. On the Nasdaq down a little more than 1%. We're 25 minutes away, 30 minutes away from the opening bell.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
From New York, we begin with the big issue. Earnings season begins. Wall Street banks preparing for tougher times. Tesla cutting prices 20% to boost demand as the Fed lays the groundwork for smaller hikes.
Earnings. Q4 earnings season starting now.
Expectations are that earnings will fall 2%.
-4%, -6%.
When we look at tech and TMT, we think earnings are likely to come down another 15%.
It's not news that this quarter is going to be bad.
The bar is low, but the estimates for 2023 are still too high.
We think that margins are going to be under pressure.
Analysts still seem quite optimistic.
That's going to be the major headwind that equity markets have to contend with.
Tech companies have been a source of downward revisions.
The banks are all going to cost cut.
There's a lot of resilience in the banks.
Arbiter of whether or not we're going into a recession.
We need to gauge what level of losses are going to be tolerated by the markets.
We're actually hoping to use some of that weakness to actually buy it.
Earnings is one of those key questions that we need to find an answer to.
Let's get straight to Bloomberg. Shonali Basak. Hey, Shonali.
John, you're looking at banks who are bracing for an uncertain macro environment as well as uncertainties around both the top and the bottom lines. You're looking at JP Morgan. Jamie Dimon now talking to analysts on a conference call, talking about the net interest income expectations that did fall short for the year when you compare them to analyst expectations. Now, why is that? Because there's an expectation that with rates going up this fast, there will be more migration to savings products. But on the other hand, too, at JP Morgan, Bank of America, Citigroup, you do have headcount rising. You have JP Morgan executives telling analysts as well that there is still pressure on some costs, including labor inflation. So with all those bonus discussions that we've been talking about all year, you do still see compensation costs overall at the bank rising. Over at Citigroup, it is worth noting fixed income traders, they blew through the roof here. Remember, macro environments being as volatile as they are pretty good for these trading desks. Question is, does that continue? You have Jane Fraser saying in a statement announcing that the bank is very much on track to meet targets, the medium-term targets they've set out. Jamie Dimon also saying that they will meet their targets in the current quarter. Actually, they surpassed it meaningfully when it came to a return on tangible equity. But you do have longer-lasting questions here on where the money comes from in a tough year.
This all goes to the outlook. Looking ahead for another tough year, another 12 months. Jamie Dimon, the CEO, said this: "We still don't know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine." Goes on to say the vulnerable state of energy and food supplies, persistent inflation that's eroding purchasing power and pushing rates higher, and the unprecedented quantitative tightening as well. Just make sense of all of this for us. Jamie Dimon talked about a hurricane. The headwinds are still to come. Where are we now, Shonali?
Some of the headwinds are good. If you looked at the volatility and what it's done for trading over the last year, it's been a windfall. Of course, in the most recent quarter, you saw some pressure on that, them coming in below expectations on fixed income in particular. Where does that bode for some of the other banks and the money then that will be left to keep paying people at a higher rate as headcount grows? But as you're saying here, you're seeing it in part in the reserve builds. I think the reason this is interesting, John, is because you are seeing a lot of that reserve build in the card businesses, which are growing. So you are seeing in a very competitive environment, even in a tough environment, the banks at this point still leaning in on risk-taking. Similarly, in the value at risks in JP Morgan's trading books rising a little bit, that shows you a more competitive environment in which the banks are willing to take on some risk and potentially some costs that come along with that.
Morgan Stanley, Goldman Sachs, Tuesday. Long weekend here stateside. What are you looking for, Shonali?
I'm looking at trading. It's trading, trading, and more trading. But also remember something interesting to look at the side to supplement that trading is asset and wealth management. Goldman's restatement of their earnings show you that leaning on asset and wealth management as platform solutions / consumer businesses are giving you $1.2 billion worth of losses in the first 9 months of last year. So where does that bring total losses for the full year for Goldman Sachs? And can they show that asset and wealth that is growing as they pivot that business? At JP Morgan, there was a significant decline.
Shonali, thank you. We'll catch up with you a little bit later around the open and bow. Those stocks, JP Morgan down 2.6%, Citigroup down by not even 0.1%, Bank of America down by 1.8%, Wells Fargo struggling, as you can all see on the screen. With us now is Crossmark's Bob Dole, Nadia Lovell of UBS. Nadia, you made a move on the financials recently. Run me through why and whether these numbers this morning backs that up.
Absolutely. I mean, we recently downgraded financials to least preferred after strong outperformance off of the October low. We decided to do that into the strength. I mean, we're not surprised by the pullback that you're seeing in the banks today. I mean, historically, over the last year plus, we've seen weak trading around earnings after banks have run into earnings. We think that there's just earnings risk ahead. I mean, as Shonali has pointed out, the economic slowdown, we think that net interest income is peaking and will decelerate it. As we hit those peak in rates, deposit payers are rising, they're picking up, and that's going to pressure margins. Also, we think that the inverted yield curve will be problematic for spread. Loan growth is slowing. We've seen that in the senior loan officer surveys that tighten up lending standard. And credit quality, while that remains pretty benign right now, you're seeing the banks build reserve, and we expect more reserve builds as the credit environment deteriorate, those charge-offs pick up. And so we just think it's going to be a harder environment for banks, and they're not going to be able to pull those expense levers as they've been able to pull in past slowdown, given wage inflation and also the need to continue to invest in technology to remain competitive. So that's why we also downgraded financials.
Bob Dole, are you on the same page?
Yeah, largely speaking, I think a lot of the verbiage that came out of these earnings reports point to more difficulties going forward. Nadia did a good job outlining them. The labor cost problems, the problems with the inverted yield curve, what that does to net interest margins, lower income consumers using those credit cards. There are going to be some loan losses there. So their environment is tricky going forward. Now, he said that the stocks are pretty cheap relative to most measures. And so I don't think there's huge downside, but there's some adjustment going on here.
Nadia, just to go back to the broader earnings story, where are you expecting the biggest downgrades this earnings season?
Yeah, I would say the earnings expectation for the fourth quarter has probably come down enough. We've seen a massive downward revision since the third quarter. And so the consensus right now is calling for the first negative earnings since there is recovery, so 3% decline. But I think when you look across the board, we are concerned about the outlook. We think that that's where there's some concern, particularly on the more cyclical sectors of the market. I mean, can you believe it that the consensus is calling for double-digit earnings growth for financials, consumer discretionary, industrial? That's just perplexing to us to see near record or record earnings for these sectors. So we think that there's increased risk to those economically sensitive sectors as the economy slows down. We also even think that there's some risk even to tech.
So I understand why you like staples then. I understand why you like healthcare. Why energy? Nadia?
Oh, I'm sorry. Oh, I thought that was for Bob. Yes, in terms of energy, we just think that the drivers are still there for higher oil prices. They're still in place. We think that there's just a weakness that you've seen year to date will fade. I mean, when you look at Russian oil, that's still selling well below the $60 price cap that was put into place in December and half the global price. And it's becoming very difficult for Russia to sell its oil. We think it's going to become even more difficult when the embargo goes on refined products on February 5th. And then you have China reopening. That's going to put upward demand on energy. India still remains strong. So that incremental demand is going to come from emerging Asia. And so we continue to believe that Brent oil is going to get to $110 this year. And so that's why we continue to like energy in this environment.
22 repeat on the cards for you then, Nadia. Bob Dole, are you on the same page? Energy, staples, healthcare, the winners are 22, the winners are 23?
Yeah, largely speaking, I think the financials will have a better back half of the year. Healthcare is not all that cheap, nor are staples, although we like them. But I want to underline the energy call based on, among other things, the discipline these companies have in how they're using the enormous cash flow they have in terms of how many holes they drill in the ground. So I think these companies are changed from what they were in a positive direction.
Have these companies changed? United, American, Delta, these airlines year to date have absolutely ripped. I can go through some of the numbers for you. United Airlines up 36% over 8 trading days. Delta's down this morning off the back of numbers, but before that, Delta up by more than 20% over the last 8 trading days year to date. American up by 32%. Even Southwest is up close to 10% year to date so far. Nadia, can you make sense of what's going on here? The first 8 trading days of the year and these massive gains we're seeing in this sector.
We think that this market is still in a downward trend. I mean, the massive move that you're seeing in some of these single stocks and some of these industries is quite concerning to us because we just don't think that we're out of the woods yet. I mean, even the meme stocks are rallying. And so we think that the rally that you're seeing remains quite fragile, and we think that you're going to see it stall out around this 200-day moving average as we've seen in the past bear market rallies. We think that you're not going to really see an upward trend in the market until we get to a bottom of that economic data and earnings. And so we would expect a pullback in some of these stocks that have had massive rally in the last couple of weeks. We just don't think that there's enough downward earnings revisions, not yet.
Well, let's talk about how long we have to wait for that downward revision to this economy. Bob Dole, let's talk about the right here, right now. Neil Dutt of Renaissance Macro, a man who we've quoted a lot on this program over the last couple of months, is very constructive on where we are right here, right now. He said this morning: Europe is warming up, likely avoiding a technical recession. China is reopening. The Fed is stepping down from an aggressive rate hike pace, and fiscal policy is no longer a drag. He went on to say the Fed expects real GDP in 23 to slow down to 0.5% Q4 on Q4. And he finished with this: good luck with that one. Bob Dole, what do you say back to that?
So a lot of good points there. I think what we don't know, and perhaps what Neil's missing, is what effect what the Fed has already done will have on the economy. Second fastest rise in Fed funds rate in history. And that operates on the economy with a long and unpredictable lag. The effects, I think, still will be seen, and therefore the earnings risk, and therefore hard to see a lot of upside in the market.
Why do you think it's taken so long? Or do you just need to be a little bit more patient? How long do you think this takes, Bob, just to feed through?
Remember, they didn't start till last March, as you remember, John, and a lot of it came in the middle of the year, in the fall. Those lags are 6, 12, sometimes 18 months. So I think we're yet to understand what effect that will have. Not to mention, the balance sheet issue they have to deal with.
We'll keep building on this story. Bob Dole, Nadia Lovell sticking with us. Equities down by about 1% on the S&P. Coming up, Fed officials leaning towards smaller hikes.
Now, with forward-looking real rates positive across the curve, and therefore our feet unequivocally on the brakes, it just makes sense to steer more deliberately as we work to bring inflation down.
More on that still ahead.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
This is Bloomberg.
Forward-looking real rates positive across the curve, and therefore our feet unequivocally on the brakes, it just makes sense to steer more deliberately as we work to bring inflation down.
The Richmond Fed President Tom Barkin teeing up a downshift potentially to smaller rate hikes. The Fed's Patrick Harker supporting that move. The days of us raising by 75 basis points have surely passed. In my view, hikes of 25 basis points will be appropriate going forward. Mike McKee putting it all together for us. Hey, Mike.
Hey, John, I don't think, in all seriousness, that the debate is about the speed anymore. It's more about the destination. And there is a real disagreement between Wall Street and the Fed on the destination. Now, this week we've heard from Susan Collins, Patrick Harker, Tom Barkin, and Jim Bullard. And while they disagree on the speed, they're all saying the same thing about the destination. Take a look at what Harker and Bullard had to say yesterday. We need to get rates above 5%. How far above? We'll let the data dictate that. And the median dot said the policy rate would be somewhat above 5% at the end of 2023. That's what the Fed thinks. But take a look at what the market thinks. The market thinks the Fed isn't going to get to 5%. The Fed's forecast is 5.12% if you want to use the median dot from December. The L line there is where the market thinks the median is going to be. And that is not the same number. The market is also pricing in rate cuts for next year. The battle is going to be over the next couple of months. Is inflation going down fast enough, or is the economy turning badly enough that we need to see rate cuts? Jeff Gundlach, Double Line, said there's no way the Fed's going to 5%. The Fed's not in control. The bond market is in control, to which Minneapolis Fed Neil Kashkari this week in the New York Times had this rejoinder. They're going to lose the game of chicken. I can tell you that. So this is going to be fun to follow as the year goes on.
Well, we'll keep following it. But Mike, I guess at this point, what's the disagreement really over? Inflation? Do the market seems to believe that inflation's going back towards target quicker than some of these Fed officials?
Well, there seem to be two camps. One agrees with that theory that inflation is coming down faster and the Fed will not have to react. And the other is that the Fed is going to push us into recession and therefore they're going to have to cut rates. Now, the problem with the first argument is even if inflation comes down, if the rest of the economy is doing fine, the Fed would not have to cut rates immediately. And they don't really want to. They'd like to keep rates higher for longer because they got down to zero for so long and had few tools to fight recession. So if they can, as somebody put it yesterday, normalize, I hadn't heard that term in a while, normalize rates to the 3 to 4% range, they'd be very happy.
I think we've forgotten what normal is. Mike, thank you, sir. As always, Mike McKee there breaking it down. Pace, speed, and destination, where we end up. This came from Citi. Philadelphia Fed President Harker argued for a few 25 basis point hikes and accepting a slow decline in inflation, but we do not think he speaks for the committee. We continue to expect the Fed to reach a terminal rate of 525 to 550. That's the Citi view. Bob Dole, what's the Nuveen view? What's yours?
We think we'll get to 5, and that we'll be there at the end of the year. And we might even have a mild recession. Look, the Fed waited too long to get started. I think they're going to sit tight and let inflation fall once they get to where they're going to go. I disagree with the 4 handle for the terminal rate.
Nadia?
You know, I think if it weren't for the job market, we would say that the Fed has enough inflation data, the downward trend to pause, but we're just not there. So we're looking for 25 basis points in the next hike, and we're looking for a terminal rate to get around 5%. I think that the job market has been sending us very mixed signals. We saw wage growth moderate last week in the jobs data, but we're looking for more the ECI later this month, and also comments from corporation in the beige book to get a better sense of the labor market, because that data last week that we got was quite noisy. And so we do know that the labor market still remains really tight, and we need that to come back into balance. Not just about wage growth right now, it's also the labor market to come back into balance in terms of the demand versus the supply, for the Fed can feel comfortable in sort of pausing. But we think ultimately you get to a terminal rate of 5%.
Can we talk about that noise in the labour market just a little bit though, Nadia? What you see is unemployment at 3.5%. Wage growth softened a bit. Hours work came in just a little bit as well. Then I look at claims close to 200,000. I look at job openings and the quits rate, and everything looks pretty decent. Which one is it?
We would side more with in terms of the claims, the unemployment rate, and also the job openings. We know that there is 1.74 jobs for every person that's unemployed. That is just too tight. So even throughout the earnings season, we're going to be listening to hearing from corporations. What are they hearing in terms of how they see the employment picture? We know that there are layoffs in tech, but we also know that there's still tightness on the service side. So is that starting to ease? Because we think we need to see that before you can say that we are clearly in a downward trend in inflation.
Well, to that point, Bob, never mind recession. Are you seeing evidence of any real softening in this labour market in America?
Not at all. This is the Fed's biggest problem, as we've been stating, that the unemployment rate and the labor report last week went from 3.7 to 3.5. Only compounds their problem. There are just not enough workers out there, and therefore getting slowdown in wage growth is going to be really difficult.
Bob Dole, alongside Nadia Lovell, to the both of you, thank you on this equity market as we work through some of these themes. Equity market right now down about 1% on the S&P 500. Looking at this bond market at the moment, bond yields set up as follows, up about a basis point or so on a 2-year to 4.15, on a 10-year to about 3.46. Elsewhere in foreign exchange, we need to talk about this a little bit more this morning. Some major moves developing. And think about where we've been, where we were, and where we are now. We've moved on the dollar by about 10% since late September. On dollar yen, 128 on the screen, we were at 150. Euro dollar, 95. End of September, now 108. You can take your pick at the moment. Take a look at cable. At the end of September, 103.50, and now it's through 120. Can that continue? Is that sustainable? And what does it mean for the path forward? We mentioned Caterpillar a little bit earlier this week. Caterpillar, all-time highs earlier this week. Take a look at the chart at where Caterpillar bottomed, which was the end of September, and where the dollar peaked at the same time. And this enthusiasm for this reopening story in China, encouraging people to get back into EM, back into the miners. Even in Europe, just some relief that it's not as bad as we thought it would be, just leading to a massive rip that you've seen in some of the European names, but some real pushback from the team over at Bank of America today on that theme out of Europe, and I can quickly bring up the note for you. It comes from the team over at BofA. In the European desk, they said this: the biggest upside risk is China reopening, but we think the impact on European equities from a US recession will be dominant. We see nearly 20% downside on the stock 600. They go on to say, lower bond yields, widening risk premia, EPS downgrades, and cyclical underperformance. And the team at BofA pushing back pretty aggressively against what you're seeing develop over in Europe at the moment. The stock 600 today up 0.1%. The DAX pretty stable and unchanged. The big story, the FTSE up 0.4% again this morning. Guy Johnson's going to talk about that a little bit later. Coming up, the morning calls, and later, earnings season getting underway. Baird's David George seeing a favourable setup for the big banks in the year ahead. Plus, Morgan Stanley's Jim Karen joins us for the opening bout. All of that still ahead with futures down about 1%. This is Bloomberg.
Connection lost.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
5 minutes or so away from the opening bell. Equity futures down here by 1% on the S&P, and the Nasdaq at the moment down by about 1% also. If you tee up the bond market, 2s, 10s and 30s, look a little something like this. Your 2-year yield up 2 basis points to 4.17. The trend through much of the year so far, though, year to date, yields coming in on a 10-year 3.47, back in October 4.33. You understand the trend. Yields rolling over, dollar a little weaker. Equity market supported to start the year at least. That's some of the price action. Let's get you some morning calls. 3 of them. Here's the first. Bank of America upgrading Caterpillar to buy, saying higher prices and better earnings will provide some shelter from the economic slowdown. That stock's been flying, up another 0.5%. Next up, Guggenheim downgrading Tesla to sell, warning that new incentives and recent price cuts will likely weigh on the automaker's margins. I'll get you some more Southside calls in just a moment on Tesla. That stock is down hard by a little more than 5% at the moment to 116.64. And your third and final call from RBC Capital, downgrading the US home builders, expecting numerous headwinds to drive significant downward EPS revisions. KB Homes, difficult couple of days. That stock is down by 1.5% to 34.40. They're 3 of the morning calls. Coming up, earnings season kicking off. Wall Street's biggest banks gearing up for a challenging year ahead. That conversation up next with Morgan Stanley's Jim Karen and Baird's David George. Looking forward to that. Your opening bell 4 minutes away. Equities down about 0.9%.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Seconds away from the opening bow this morning. Good morning as we wrap up the trading week. 3-day winning streak on the S&P 500 after the close yesterday. That is the longest winning streak since November, believe it or not. That's how bad it's been. Equities right now down about 0.9%, looking to close out the week, maybe on a softer note on the Nasdaq, down by about 1%. There's your opening bow. Switch at the board and get to the bond market. Yields shaping up as follows. 10-year yields higher by a couple of basis points. 345.95 on a 10-year. In the FX market, the dollar trying to show some strength. Euro dollar 108.03. We're down about 0.5%. Crude approaching 80. $79 and about 10 cents, up 1% on the day. About 15 seconds into this, equities down by 0.8% on the S&P. On the Nasdaq, we're down about 0.8% also. One sector to watch at the open, the big banks. JP Morgan, Bank of America, Citi, Wells, kicking off earnings season. Abby has the price action. Hey, Abby.
Hey, John. Well, yeah, a bit of a disappointment here. We can see that all four of these big banks are trading to the downside on the unknown of the macro situation and what it could mean for revenue and profit going forward. Now, relative to JP Morgan, that stock is down about 3%. They had a disappointing net interest income guide of 73 billion versus 74.4 billion. That was the estimate. Citigroup, interestingly, the stock had been almost higher earlier, right now down about 1%. Their FIC trading, they actually smashed that number. The iBanking and equities a little bit light, however. Bank of America, those shares are down 1.2%, relatively clean quarter, beats in net interest income. And then rounding it out, Wells Fargo doing the worst at this point, down 3.4%, surging expenses. They missed revenues slightly. They do expect the economy to worsen. Now, if we take a look at net interest income, we are going to see here, or excuse me, the provision for loan losses, much larger than expected. Not a great sign for some of these banks. JP Morgan leading the way there. And then finally, price action, John. You know, it's interesting. So we have these banks trading off today. All four of these banks on the year, over the last year, down about 20% or more. But take a look at this rally that we're seeing in JP Morgan and the banks overall. The banks overall, out of that October low, up about 20%. But JP Morgan ahead of today had been up closer to 35%. So we're seeing this dip. It's going to be interesting to see if it continues. But that trend to the upside right now, it looks relatively strong.
It's in a massive rally in that name since October or so. Abby, thank you for that. Equities more broadly about 2 minutes into the session, down about 0.7%. No real drama here. Hearing a lot from Jamie Dimon, warning some investors of further economic uncertainty and saying this: we still don't know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine, the vulnerable state of energy and food supplies, persistent inflation that's eroding purchasing power and pushing rates higher, and the unprecedented QT as well. Shanali on top of it all. Hey, Shanali.
John, not surprisingly here, as you're seeing those economic uncertainties really start to bake in, you are starting to see some very interesting cracks in borrowers when you think about consumers as well as corporate customers. Let me draw those out for you really quickly here, because charge-offs over at Citigroup, for example, rising. Remember, they are still coming off historical lows. These are not crisis era types of charge-offs we're seeing, but they are indeed starting to rise. Remember, this is as credit cards largely have risen very meaningfully, especially after the pandemic in more recent quarters for both Citigroup and JP Morgan. So when you see these reserve builds, that's really what you're talking about here. It helps them ink that net interest income that you like to see so much. For JP Morgan, though, however, they are going to likely come in short of expectations for the year. Part of that is because you're watching really deposits start to come back, especially in some of those higher yielding products like CDs. I will also say, interestingly, over at Citigroup, you are expecting a higher than expected revenue for the year. And what Jane Fraser is saying is still the phase one of her turnaround story. Because it is indeed phase one, John, you are also likely to see higher expenses than expected. Overall, on the conference call over for JP Morgan, you are hearing Jamie Dimon and you're thinking, is he sitting there penny pinching here? Because he's getting questions about expenses as well, and he is drawing out his dollar in, dollar out analysis for analysts here. Every branch we open and every banker they hire, they have to ask themselves what those dollars are coming in per those people.
Shanali Basak, thank you. Just on the financials, Ken Leon of CFRA saying financials can stay strong even as the economy cools.
I think if you have an environment of not too hot and not too cold, it's a great environment for financial sector, particularly banks, where the expectations are not as high as perhaps other areas that have benefited with a strong bull case scenario. Banks actually are in a pretty good position for performance for 2023 as we see it.
Pleased to say that David George of Baird joins us now. David, we often do this every quarter, so thanks for being with us, sir. I know that you're neutral on JP Morgan. You were neutral on Bank of America. Does anything about today's numbers change that?
Hey, John, good to see you again. Happy New Year. No, not really. I think certainly a lot of your comments this morning, it's totally ring true. But I think it's important, and I know the stocks are down today, to have some perspective. JP Morgan came in, we wrote in our note, the stock came in really hot. The quarter was fine. They made $11 billion. You think about everything that you and Shanali were just discussing, they earned $11 billion in the 3 months. So fundamentally, despite all of the uncertainty, all of the macro fears that are out there, it's still a fantastic business model. And from our perspective, it was just a valuation issue going into earnings more than anything else, rather than any meaningful fundamental issue.
David, something you said coming into earnings season, reasonably good, the setup versus the broader market. Why is that?
Yeah, so coming into 2023, to give you some context, we have a fairly constructive view on financials. And one of your earlier guests just kind of mentioned the bars a little lower. If we think about a year or so ago when maybe we were having this conversation, John, the stocks were 25% more expensive. And the earnings outlook is actually better today than it was a year ago. And that's a function of more aggressive Fed tightening than maybe we would have expected a year or so ago. So the revenue outlook is actually pretty good. Now, it's really a function of what does the credit environment from here look like and how does that unfold? And we're of the view that it doesn't have to be binary. It doesn't have to be a soft landing in one camp and the great financial crisis in the other. We're of the view, and we're generally calling the 2023 the year of normalization in all things, and really kind of going back to 2019 as a core growth guide since we've had so much unusual activity and between Fed stimulus and taking that away. We're of the view that things are going to normalize really throughout the economy and the banking system as well.
David, when you say normalize, what does that word really mean? What does normal mean these days?
Well, we try and view cyclical stocks like banks, John, through a normalized lens. And what that means, more than anything, is what is normal from a credit perspective and credit costs in general. So JP Morgan, as an example, they only had 32 basis points of credit losses. What we would consider to be normal would probably be something in the order of 50 basis points. So it's while we're fully on board with the notion that credit is going to deteriorate, it doesn't mean that we're going to have a GFC-like scenario. banks take risks and they're expected to have losses. That is actually part of the business. So I think sometimes we get too caught up in the day-to-day delta, as it were, in terms of credit, as opposed to just thinking through the cycle, what's normal, and taking more of a kind of intermediate term view as it relates to that.
I'm about to get caught up with what's happening on the screen right now. Wells Fargo down by a little more than 4%. That's a stock you like. David, what happened this morning?
Yeah, it is. So a couple things. The expenses were higher than expected. They're taking some significant operating losses, which we think are to try and get in front of some of the regulatory issues that are certainly well publicized. And their net interest income outlook for 2023 was a little disappointing. And thematically, one thing that we've seen so far is the net interest income outlooks for the full year are a little light relative to where I think consensus kind of came out. And that's a function, John, of deposits and low-cost deposits moving out of the system into higher-cost alternatives. And that NII impact may be a little more muted than maybe some market participants expected.
Is that another way of saying they might be competing for our deposits sometime soon, David? Are they going to have to pay up for that?
Well, I think that's yeah. To answer your question, yes. I think that's going to be an industry-wide phenomenon as we go through 2023. I think there's going to be more of a food fight for deposits, and the days of paying 1 basis point for funding, we think, are generally over. And so that's going to be thematically something that we keep an eye on for sure.
I think a lot of us are happy with that. David, thank you, sir. David George there of Fed, thank you very much. You brought our equity market about 9 minutes in, down 0.9%. Jim Karen of Morgan Stanley joins us now. Jim, I just want to go straight to earnings with you. You look at the data, you look at what's happening with companies, and I know you see a bit of a problem ahead for profit margins. Why is that?
Well, look, I mean, I think it all really stems from what's likely to happen with the broader economy in terms of GDP growth. If you get slower GDP growth, you get, consumption, comes down as well. Consumption brings down GDP growth. And when we see the labor market, which we think is starting to soften up a little bit, that means consumers have less money. So what that then means is that corporations cannot pass on higher costs to the consumer. The consumer is just not going to be able to pay those costs. So what then that feeds into naturally is tighter profit margins. Once you start to get profit margins starting to narrow, you start to get this vicious cycle, because the way that corporations then go on to think about supporting those margins is by laying off more workers and controlling labor costs. And I think this is really the macro backdrop that we have to worry about in terms of thinking about this negative feedback loop that can start to work through the economy in 2023. And as I like to say, well, don't like to say it, but 2023 could be worse for Main Street than actually for Wall Street, because this is the environment where I think the consumer actually starts to feel the pinch of the long and variable lags of Fed policy.
So almost like the reverse of last year, Jim.
Yeah, in many ways we can think about it as the reverse of last year. It's really a lot of these long and variable lags that are really starting to come home here. So look, I mean, I think the Fed is in a very interesting position in terms of how we think about how we think we're going to grow in 2023. In some cases, I think maybe some people might consider the Fed as chickening out on their inflation mandate. Look, inflation is coming down. We had a month-over-month CPI print yesterday come out negative, and we haven't seen that really since 2020. So, and that was just before the pandemic. So essentially what we're starting to see, our price pressure is starting to come down, and I think that's good, but it's coming down at the expense of slower growth and also potentially weaker employment, weaker labor, and also declining wages. So all of this then feeds through to GDP growth, to earnings, to profit margins, and that's the cycle that's ahead of us. And John, I think the real question though is how much of this is in the price? How much of this do we think is actually already there, and will we do worse than what people are already thinking? Because many people think the first half of the year is really where the adjustment's going to take place.
So Jim, here's my market question. What makes less sense, the S&P 500 near 4,000 or high yield spreads near 400?
I would say high yields. Well, okay. Well, this is good. Now let me frame this. I'm actually more positive on high yield. And so I would say the S&P makes less sense. I would argue that high yield spreads have more likelihood to do well, meaning tighten. High yield has more likelihood in higher quality risk-adjusted returns context to actually perform better. And the reason is because if the Fed starts to pause around a 5% policy rate, maybe they go in February, maybe they go one more time in March, and then they're done, then what that means is that the default risk cycle is going to be much, much more muted. So maybe you get that soft, bumpy landing. Look, I'm getting 8% yields, little over 8% yields in high yield. Spreads are a little over 400 basis points or about 420 basis points. So I get that the spread may not come in a whole lot more, but I'm still collecting an 8% coupon. So maybe those yields actually start to come down, and essentially, which would also mean the treasury yields come down a bit as well. But I'd rather collect that 8% coupon with more certainty of an easier default cycle than try to play I'm going to guess what equities may or may not do. So the way that we're structuring it in our balanced portfolios is we're trying to think about those two risks and try to find which is the better quality risk. And I'm leaning towards thinking that high yield is that higher quality risk.
Hey, Jim, stick with us. Jim Karen and Morgan Stanley there, looking at high yield over equities right now. Your equity market at the moment, about 13 minutes in, down 0.8% on the S&P and on the Nasdaq too. Coming up, Tesla cutting prices by up to 20%.
It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going.
And that conversation up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you have a stock that's down 70%, I think that's the beginning of a train wreck. It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going. And why would you jump in now? Why wouldn't you just wait to let the dust clear? Because I don't think it's going to get away from you.
Tesla slashing prices by up to 20% across the US and Europe in a bid to boost demand. Analysts on Wall Street starting to sound the alarm. Evercore writing the following: there will be a significant impact to Tesla's near-term gross margins. The math depends on how long these new prices last. Ed Ludlow has more. Ed.
Yeah, good morning, Jonathan. Tesla down 6%, meaning it is now down 6% year to date. This focuses largely with more significant discounts on Model Y, 20% on the base Model Y here in the United States, as you said, or $21,000 off the more expensive higher-end performance model. There's more modest trims in price to the Model 3. What's so interesting is the emphasis Tesla is putting on that $7,500 incentive, which will last through to March of 2023. I think what's so interesting about the sell-side analyst reaction is not that this will result in a hit to gross margin, but actually that they see a pretty significant miss on that margin when we get fourth quarter earnings in a few weeks' time. This is coming off the back, of course, of price cuts in China, multiple price cuts. I think the debate now around whether there is a demand issue has probably gone out the window, but it depends how long these price cuts last. And indeed, it can be a lever that spurs demand. And so I think we want to know the duration of the price cut and then what volumes will be going into 2023. There is some skepticism from some in the market that that target of 50% average annual growth on production and deliveries will be achievable for the coming years.
Let's start with a bull case. Tesla at 116, down 5.8%. Dan Ives of Wedbush, outperformed still 175. Said this: we believe altogether these price cuts could spur demand deliveries by 12 to 15% globally in 23, and shows Tesla and Musk are going to be on the offensive to spur demand in a softening backdrop. That's the constructive view. Let's put that to one side. The bigger issue for investors right now, Ed, is how to value the company. And you saw this from Wells Fargo. They asked the question of the moment for Tesla. There is a growing debate among institutional investors on how to value the company. Is it auto or is it tech? Which one is it?
Yeah, I mean, I go straight to 12-month forward earnings. I think we're around 25 to 30 when it comes to 12-month forward earnings, right? There's an interesting, way of looking at this, that if you applied a similar multiple to Tesla that carries for Ford and GM as an example, then the market cap that Tesla currently has would come down very significantly. You and I had this discussion many times over the last 3 years, right? That a lot of the valuation was put because of full self-driving, the future promise of robo-taxi. Now that the economy has changed coming out of the pandemic, there is a realization that Tesla is starting to be valued simply as a company that makes cars, and that demand for those vehicles is starting to pull back slightly. But there are many that are still bullish on the longer term about the software part of this business.
It's been a difficult year for both autos and for tech as well, for that matter as well. Ed, great work as always. Tesla over the last year, you can see it there on the screen, down 66% over the last 12 months. We are about 20 minutes into this. The equity market's down about 5 or 6/10 of 1%. I want to get a final thought now from Morgan Stanley's Jim Karen. Jim, I think you've been out front on this. You don't talk about defense, you talk about balance. Can you tell me the difference right now as we look ahead to a pretty uncertain 2023?
Yeah, so look, I mean, many people think about being defensive as ways to avoid risk or ways to participate in assets that just do not have a large movement in the markets, just tend to be lower volatility. Now, what I think is very, very important is that we balance those risks, meaning that we are in a situation where we have fat tail risks, meaning that we could get a hard landing, you could get a soft landing, and good things happen, and we have to balance those two things. So we can start by looking at cash, for example. We can start by looking at short duration instruments and funds in that area, and say that yields are pretty good. 3-month T-bills, yield above 4%. That's a good place. Now, do you balance that by owning equity and high yield and other assets as well? Because if you're in an environment where you do get a risk-on move in the markets, the one thing I think is a risk is risk on. And I want to say that very, very clearly. Risk on is a risk. And the reason I say risk on is a risk is because people are underinvested in the markets. If you look at what is in money market funds these days, it's almost $5 trillion. So if you get a very positive move in the market, you can't afford as an asset manager, as a money manager, to move to miss that move. So you want to be in safer assets like short duration, high quality fixed income assets. But but you also want to balance that against owning things where, if rates come down, if we stabilize, if we get a soft landing, asset classes like high yield, credit, and some high quality, maybe value orientated equities can also do well too. You want to be able to balance those two risks so that you reduce the risks through diversification. So the difference between defensive and balance is that balance reduces risks through diversification and keeps an eye on risk controls in that sense.
Hey, Jim, this was great. Jim Caron and Morgan Stanley. Jim, thanks for sticking with us, working through a lot there in both the equity market and in fixed income as well, and a little bit of portfolio construction at the end. About 23 minutes into the session, equities down 0.5% with a sector price action. Here's Abby.
Well, John, we are certainly coming off the lows. The S&P 500 now down about 0.5%. We have two sectors that are slightly higher, healthcare and staples, defensive sectors to the bottom, not surprisingly financials, but John, down just 1%. Some of those banks down less than 1% at this point, so it's going to be interesting to see how this day plays out. Tech right in the middle, down about 0.8% on the week, though, John. This is interesting. So we're looking at a second up week in a row for the S&P 500. Year to date, we have the discretionary space very strong, up 6.5%. You can see Amazon is a big contributor to that. Home Depot, too. But take a look at Tesla. Yesterday, I believe Tesla would have been about flat to up on the year, but now on the 20% price cut that you all were just talking about, down 5.4%. Super interesting. At its peak, Tesla, 20% of that sector, now about 10%.
Abby, thank you. Some big moves there for you. The broader market, no real drama, down 0.5%. Up next, your trading diary.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Minutes in, equities down 0.5% on the S&P, on the Nasdaq down 0.5% also. Just a little softer, lighter negative as we close out the week. That's the price action. Let's get you the trading diary. Coming up, UMich Consumer Sentiment Survey at the top of the hour. More Fed speak, Kashkari, Harker on deck. Looking ahead to next week, US markets closed on Monday. Bank earnings picked back up with Morgan Stanley and Goldman. Plus, we'll hear from Fed President John Williams from New York. That does it for me. For those of you stateside, enjoy the long weekend. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This is Bloomberg.
Chris, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines, because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.8 2.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home, but in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. And class? One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gauridoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city, and and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition center, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of one thing to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ads at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have